I'm going to be walking you guys through a checklist on exactly how to find the draw on liquidity using ICT's concepts. Let's jump straight into it, and I'll be showing you guys the examples for both the bullish and bearish case. The first thing that I look at is institutional order flow on the higher time frame. That's what HTF stands for. So I'm looking to see, are down close candles being respected to push price higher? That would be bullish institutional order flow. Or are up close candles acting as resistance to then push price lower? That would be bearish institutional order flow. So I'm identifying if we're in a buy program or a sell program. Also, while institutional order flow is bullish, price is going below old lows for smart money to buy the sell stops. It's also retesting other PD arrays, which we will talk about before heading higher. It doesn't just have to be order blocks. So that's the first thing that we take a look at, and I'll be walking you guys through the checklist in these examples in 1 second. The second thing that I look at is, are buy stops or sell stops purged? So now after we identify the institutional order flow, we're marking out those higher time frame PD arrays, and we're going into the lower time frames, and we're looking for pretty much the 2022 ICT model. So we're looking for a purge on buy or sell stops depending on which example it's in, whether it be bullish or bearish. And within that, after it does take liquidity, we're looking to see, can we get a market structure shift for the third point of the checklist? And while it creates that market structure shift, does it create a fair value gap in that leg that creates the market structure shift to the downside? So that may sound a little confusing, and I'll be walking you guys through the examples to hopefully clear that up. Also, I did lose my voice, so if I sound a little bit different, that's why. So let's dive straight into the first example on NQ. This will be how to find the draw on liquidity in a bullish example. You can see that institutional order flow is bullish. That's the first thing that we take a look at, and this is on the daily time frame. So down close candles are acting as support. You can see that price is returning to this bullish order block. The entire down close candle is an order block. Usually ICT will mark out the open of it and potentially the mean threshold and upper wick. Those are just sensitive points of the order block. So institutional order flow on the higher time frame is bullish here because price is returning to these down close candles and just retesting them as support before continuing higher. Also, price is respecting discount fair value gaps, and price is going below old lows just for smart money to buy the sell stops before continuing higher. These are all signs that NQ is in a buy program. So now how do we find the draw on liquidity for the next move? We identified that institutional order flow is bullish, right? How do we use that information to now apply it to look for future moves? So the next thing that I like to look for is I like to look for fair value gaps. I like to look at order blocks, breaker blocks. I like to look at old lows, and I mark these out on my chart. So you can see that we do have this discount fair value gap right here, which is just a gap between this candle's high and this candle's low. If you want to know what fair value gaps are, watch the previous lesson in episode 1. This is episode 2 right here. So you can see that we do have this daily fair value gap. What I like to do is I like to just mark out 1 day, just so I know when I go into my lower charts, this is a fair value gap from the daily time frame. And when we do draw a fib from swing high, or from swing low to swing high, this is in a discount of the range. So below the 0.5 fib is a discount. So dropping down to a 4-hour time frame here, you can see that we had all of this engineered liquidity. So what does that mean? It means that all of these lows are clustered very close together. So ideally, if I'm looking for longs, I want to see all of this engineered liquidity taken out first. You can see that we have a lot of low resistance liquidity right here, meaning it's just failing to create lower lows. It's engineering liquidity. Retail traders are putting stops beneath each of these lows right here. The algorithm lets that happen, so then they could take out those lows. They could utilize that run on sell stops for smart money to gather more liquidity before the real move to the upside. So how do I figure out what the draw on liquidity is? If you guys follow me on Twitter, you know that I did post this when price was around 15,010 here. I said looking for the equal highs to get taken out at 15,152.5. After that, I'm looking for price to run into that 15,269.25 level. So if we take a look back here, 15,010s right here, and we can see that it did run all the way up to those higher targets. So how did I know that price was going to do that? First of all, I identified the institutional order flow. The second thing that I looked for was buy or sell stops purged. Well, we did have these relative equal lows, so these old lows clustered close together. We had a run on those. Below old lows is sell side liquidity. Again, if you don't know what sell side or buy side is, go back to episode 1, my previous video on my YouTube. So we had a run on sell stops. So now it follows two of the points on the checklist, right? Institutional order flows bullish. We're in a higher time frame daily fair value gap, and price just ran sell side liquidity. What I'm now looking for, now that we had the run on sell stops into that fair value gap, is I'm going on to the 1 hour time frame, and I'm looking for the bullish 2022 model, which is essentially a rate on sell stops, which we had up here. We had another minor rate on sell stops right here. So we had an old low, price moved away from that low, and then it came back and took out the old low. So anyone with stop losses beneath here, their stops got triggered. The algorithm utilizes that run on sell stops to flood the marketplace with sell orders. Smart money buys from the sellers at a lower price, and then we get the shift in market structure to the upside. So now this gets to the third part of the list. We have a shift in market structure upwards. So now we have institutional order flow that's bullish. We're in a higher time frame daily fair value gap. Sell stops have been ran right here, also right here, and now we do have a market structure shift to the upside. So you may look at this and say, well, why can't you label this a market structure shift? Because the short-term high got taken out, right? So we had a high, moves away from that high, and then breaks through that high again with displacement. Why not call that the market structure shift? You could, right? And if you were to call that the market structure shift, this high would be the target. Because if smart money's long here, they're going to need to distribute price to buy side liquidity, so above old highs, right? So some people may be thinking, well, this is obviously in hindsight, but take a look. This was from my Discord on June 27th. I said I favor a run into buy side liquidity, and then after that, it could potentially run into the 0.5 standard deviation. So if we take a look at what I was looking at here, this was the market structure shift. We're looking for this high to get traded to. How far can price run past that high? We could draw a standard deviation on that move. Look for the first standard deviation beyond that level. So I was buying right here, right, in this fair value gap, and then I was selling once price hit this first buy side liquidity level, and then also up here. So I brought the receipts just for the people that are calling me a hindsight trader. I just want to show you guys that these were called in real time. So now if we're just looking at this level as our market structure shift, now we have crossed off 3 points of the checklist. What's the fourth one? We look for a fair value gap created, and ideally a fair value gap in a discount of the range. This is not required though. This is just for a better entry. So some people may be thinking it's not a real market structure shift if there's no fair value gap in a discount or premium of the range. So in a bullish example, some people may say, well, if there's no fair value gap below a 0.5 fib, it's not a real market structure shift. That's not how this works. So a fair value gap is utilized when that market structure shift is created to show if it's a high probability change in the state of delivery. Whether it's in a discount or a premium of that range is completely irrelevant. It's the fact that does it create that imbalance in price after it breaks through this high right here. So we have that. Now, on top of that, it isn't a discount of the range, which is below the 0.5 fib. So I just look at that as a plus, right? So the fair value gap, if you missed it, is right here. This is the bullish fair value gap. So now we have crossed off everything on the checklist. Now you may say, well, now what, right? You have everything. What happens next? So institutional order flow is bullish. We're in that higher time frame fair value gap. It rated the sell side liquidity. That's right here. Sell stops purged. Market structure shift was right here. Fair value gap created right here. What happens next? Well, there's two things that could happen next. Either price is going to run for buy side liquidity up here. What's the logic behind that? Smart money is long. We have a change in the state of delivery. And now the market is going to offer buy side. So the algorithm targets the buy side liquidity up here. So smart money has the chance to exit the long positions that they basically accumulated down here. Now there is buy stops above this high because there's relative equal highs there, and above old highs is buy side liquidity. The algorithm will utilize that run on buy side liquidity so smart money can potentially sell their longs to the buyers above here. That's the logic behind it. It's not just pattern trading. We're trying to trade like the smart money here. So there's two things that you could do. You could either aim for this buy side liquidity because that's where smart money is likely to take price, or if you want to be a little more conservative, you could draw a fib from this swing high to this swing low. Why this swing high? Because this took buy side liquidity and this started the huge move to the downside that offered sell side, right? So this is our dealing range. From this swing high to this swing low, this started the big move down. What I'm looking for is an imbalance above the 0.5 fib. So we have this imbalance right here. So this is a sell side imbalance, buy side inefficiency fair value gap. I'm looking for longs within this fair value gap, right? And I'm looking to place my stop a little bit lower, right? I can either place my stop down here, right? Because the stop placement of a fair value gap, if this is candle number 1, 2, and 3, I could either place it beneath candle number 2 or beneath candle number 1. Or if I think that there is a little bit of liquidity beneath us and price might just have a strong wick into it, I might just put it at the swing low. So no matter where you had your stop loss at, this is at least a 3R trade into a imbalance and a premium. If you were to hold for this high, it's a 6R trade, right? The algorithm is constantly seeking liquidity, right? Or it's seeking discount to premium or premium to discount. And within that logic, it's reaching for imbalances within a premium or within a discount. So in this example, when we draw that fib from swing high to swing low, above the 0.5 fib, since we do have this bullish model and it follows all of that criteria, it's going to want to reach for that imbalance in a premium. And I'm not looking for an imbalance to overlap the 0.5 fib. I'm looking for an imbalance to completely be over that. So let's say the imbalance was something like this, right? It was overlapping a discount to premium. Well, I want to look for the imbalance that is completely above that 0.5 fib, or you could say it's fully in a premium of the range. So those are two different ways that you could find the draw on liquidity here. All we're doing is looking at institutional order flow. On the daily time frame here, we have a fair value gap. Price raid sell side liquidity. That's checklist number 2, right? That bullet point gets crossed off. Then we look for a market structure shift to the upside. We have that. Number 3 crossed off. Is there a fair value gap? Yes, right here. So now we have all that we need to find what the next draw on liquidity is. It's either going to be this fair value gap in a premium or this buy side liquidity. Now, if you want to get more fancy with your profit taking on a demo account, of course, I'm not suggesting any of you guys trade live funds using these concepts. That's up to you if you want to make that decision. I'm not a financial advisor. But what you could also do is draw a standard deviation from this body of this low to this high, right? So on this manipulation leg down that creates the order block, what you could do is draw a standard deviation from this swing low to this swing high. And we can look for the first standard deviation past buy side liquidity. That would put us at 15,269.25. So since I was expecting this high to get hit, right, I was looking for this high to get hit. And again, this is not just hindsight, right? I called this out on my Twitter. I was looking for this high to get hit. Since I'm already expecting that high to get hit, I'm thinking that it's going to want to run past that buy side liquidity and run into that first standard deviation level. This is where I got that from, 15,269.25. So price runs above the buy stops, and then it ends up tagging that high right there, and then it kind of runs past all of it. You can see now it's right at that -1, and it's not random. That's a little speed bump area. So those are the ways that you find the draw on liquidity in a bullish example. So now let's dive into an example on how to find the draw on liquidity if bearish. And this is still the NQ price chart. And you may say, well, institutional order flow is bullish, right? We just looked at the daily here and it was bullish. Well, there are ways to find the draw on liquidity that goes against that higher time frame order flow. And I'll be diving into that here. So in this example on NQ, I'll be showing you guys how we had a few bearish setups in here. And I'm going to show you guys towards the end of the video a bearish setup that I traded in a live execution video. It's like 1 or 2 minutes long. I'll throw that towards the end of the video. And then I'll show you guys how we looked at this trade also in the Discord. So I'm showing you guys examples that I traded live. I'm not just showing you guys hindsight trades. I think it's important to show you guys that these things do work in real time. Now on the NQ price chart on the 4-hour, price came back down. It left these relative equal lows. So since it left the relative equal lows, and we didn't really tap into that daily fair value gap yet. So, right, this is those relative equal lows, and this is the daily fair value gap. Since it didn't tap into that yet, and it created those relative equal lows, I'm thinking the algorithm is engineering liquidity. So what does that mean? It means that retail traders are thinking that this is strong support. The algorithm quickly moves away from what retail looks at as strong support, so it can engineer sell side liquidity. Retail traders are putting stop losses beneath here. We get a strong move away. See these consecutive up close candles right here with that gap to the downside? This is a high probability order block. Price returns to here and we get displacement down. We're seeing sharp moves down after retesting these consecutive up close candles, which is one order block. This is showing me that we are still in a sell program because we get that strong displacement away from there. What I then did is I went down to a 1-hour time frame because I traded this live. So I'll show you guys that execution a little bit. And since we got this displacement down, right, it also created this little market structure shift right here with the fair value gap. These are all signs showing me that it wants to take out these lows. So we're still utilizing this same idea here, just we're now diving into the 1 hour chart now, because it left the relative equal lows, it pulled up to a 4 hour order block, rejected it hard, and came back down very close to this low. So now we have 3 relative equal lows. So now I'm going on to a 1 hour chart. I'm looking for the exact same thing. This is completely fractal. So this up close candle, what we could do is mark out the open of that. Now it did pull up to the upper end of that. So in this example, I'm just going to mark out a rectangle on the entire order block. So a bearish order block, this entire up close candle is the bearish order block. So some people may think it's just the open. No, it's the entire up close candle. ICT just marks out the open or the upper or lower wick sometimes. So in this example, in a bearish order block, if there was a large upper wick, maybe he'll draw out a line on that lower wick. Or since in this example, there's no lower wick really, he would just draw out the open of that. And then potentially the mean threshold, which is just 50% of that bearish order block. So see how it respects mean threshold right there. These are sensitive points of the order block. The entire up close candle is one order block though. You may say real quick, I'll go over this real quick because some people may have a question on this. On the 4 hour time frame, you may say, well, why are these consecutive up close candles a bearish order block and not just one right here? That's because we have consecutive. See how there's 4 in a row before that gap down? That makes these one consecutive order block. If we check over here, why am I just using one candle? Well, we have a down close candle, then an up close candle. There's no consecutive up close candles in a row here. That is why I used this specific order block. So remember, we're targeting these lows down here. It left the relative equal lows. It pulled up to that 4 hour order block and it rejected hard. So on the 1 hour, we have this bearish order block. Price returns to it. Here, now I'm just looking for lower time frame models. So all we're doing is using this on a lower time frame because this is completely fractal. So this 1 hour bearish order block has the fair value gap right here. What we could also use is this bearish breaker block. This is also a PD array. So see this last down close candle before the higher high and then the lower low. We could extend this out and this is a bearish breaker overlapped with that bearish order block. We also do have buy side liquidity right here. So on the 1 hour time frame, institutional order flow is bearish, right? Up close candles are acting as resistance and pushing price lower. And also price is going above old highs right here and here just for smart money to short those buy stops before heading lower. So I'm thinking that we're in a sell program until price takes out these lows, right? We have this higher time frame order block aligned with order flow, right? What's the next thing on the checklist? Are buy stops or sell stops purged? We have this old high right here. If we dive into what price action looked in this little fractal of price action right here, let's drop down to a 3-minute time frame. And you can see that we do have this market structure shift right here. We also do have a fair value gap created in that market structure shift leg. So it has followed all of the criteria. Let me re-go over it real quick. Institutional order flow on the 1 hour is bearish. I'm thinking that these lows are going to get targeted, right? Because price returned to the 4 hour order block, strong rejection, left relative equal lows. The algorithm's going to want to target these lows. So now I'm looking at 1 hour order flow. It returns to that order block aligned with order flow along with this breaker block. So these are bearish PD arrays. That checks the first bullet point off the list. Now is buy stops purged. So price runs above this old high. And then what do we get? We get a market structure shift. So that's the third bullet point, right? That's checked off. Is there a fair value gap created? We have that right here. So fair value gap's created. Now what can we do? We can go short in that fair value gap. We could draw a fib from swing high to swing low. And we can look for an imbalance in a discount of the range. I'm not using an imbalance overlapped with that 0.5 fib or overlapping a discount and a premium. I'm looking for a fair value gap beneath the 0.5 fib in a discount. So below the 0.5 fibs, a discount. Above the 0.5 fibs, a premium. It's always going to work like that. So we could go short in here in this fair value gap. Our stop can be placed either above this candle's high, which is candle number 2 of the fair value gap, or this high. Since the RR is already good, the risk to reward on this trade, I would just do above the swing high. If we target that imbalance in a discount, that's a 2.5R trade, we could take partials here, or we can completely get out of the trade. or we could hold for sell side right here. So if we let this play out a little bit, you can see that it did end up targeting this low. Now I did trade this, but I traded it a little bit different. I got short in this fair value gap, which was a later entry. So that is also potentially possible. And I actually held until this low right here. Now some people, again, may be thinking that he's just talking in hindsight, but I'm going to show you guys my executions on this. Now I did talk about this in my Discord as well. So I said NQ got very close to the invalidation. It didn't hit it yet. If it's going to head lower, I'd want to see it run for the lows now. If it goes back above the previous high, then my analysis is pretty much wrong. So I posted that. If we go into the 15-minute time frame, that is when price was right here. I was looking for it to head down here, and then you can see it does end up delivering. So I shorted in here, covered the position down here, and that's exactly why I traded that structure right there. So this was a pretty nice example of how to find the draw on liquidity if bearish. Align yourself with institutional order flow, then look for buy side liquidity to get purged, create a market structure shift, and a fair value gap. So that's going to be it for this video on how to find the draw on liquidity. I hope it was useful to you guys, and I'm going to play that video of me trading this structure live on the lower time frames, and that's going to close out this video. So have a good one.